Palantir stock has been on a wild ride lately. After hitting an all-time high of almost $125 per share last month, shares are down 30% as I'm recording on March 20th. That kind of volatility raises the question, where is this AI powerhouse headed in the coming year? Today, I'm going to break down what's behind Palantir's recent performance, examine the operational performance, analyze potential threats from the Pentagon budget cuts, and give you my prediction for where the stock is going to be 12 months from now. And let's start with Palantir's recent results, which frankly were exceptional. In fourth quarter results released February 3rd, Palantir said revenue was up 36% year over year to $828 million, significantly beating analyst estimates. U.S. revenue specifically grew 52%, with the commercial segment up 64% from a year ago. On the company's earnings call, CEO Alex Karp talked about the company's position at the center of the AI revolution. On the profitability front, Palantir achieved an adjusted operating margin of 45%, the best in the company's history. But despite the impressive numbers, we need to consider Palantir's current valuation and whether or not that makes sense. Start with the trends affecting the data analytics company. Palantir operates at the intersection of AI and government contracting. That creates both opportunities and challenges. While the company's co-founder Peter Thiel has close ties to the Trump administration, those connections may not directly benefit the business. In fact, potential budget cuts proposed at the Pentagon recently are a serious risk. The Pentagon has proposed reducing its budget by 8% annually for the next 5 years, or about $50 billion. Since government contracts represent a significant portion of Palantir's business, these cuts could impact future growth. The silver lining is that as an AI-focused company, Palantir may be somewhat insulated as the Pentagon prioritizes next-generation technologies. Additionally, Palantir's growing commercial business could offset some of the government slowdown. Now let's examine the bull case before we get to the bear case over the next year. The bull case for Palantir centers around three key factors. First, the commercial business shows tremendous momentum, growing 64% from last year. For the full year of 2025, management's expecting the commercial revenue to grow at least 54%. Second, Palantir is achieving impressive profitability. Adjusted free cash flow of $517 million in the fourth quarter represents a 63% margin. For 2025, Palantir is guiding to adjusted free cash flow between $1.5 and $1.7 billion. And third, Palantir's artificial intelligence platform, AIP, continues to gain traction with new customers. The company has nearly quadrupled its U.S. consumer base over the past 3 years, with real-world examples of dramatic efficiency improvements for clients. Despite these positives, though, there are some serious concerns investors can't ignore. So let's look at that bear case. The bear case for Palantir really starts with the company's extreme valuation. The forward price-to-earnings ratio is about 150 as I'm recording. The stock trades for a massive premium to the S&P 500's average forward price-to-earnings multiple of just over 20. Even AI leader NVIDIA trades for only about 25 times next year's estimates. On top of that, the price-to-sales multiple for Palantir is almost 70. Another red flag is Palantir's stock-based compensation. In the fourth quarter, Palantir recorded $282 million in stock-based compensation, a staggering 34% of total revenue. This creates massive dilution for shareholders. Even accounting for one-time expenses, the practice remains concerning. Finally, the Pentagon budget cuts are a real risk for Palantir as the U.S. government continues to represent about 41% of the company's business. So with these factors in mind, there's one critical metric that investors should be watching. If you're watching Palantir, focus on the growth of the U.S. commercial business. This segment represents Palantir's best opportunity to diversify away from government contracts. Management says the segment is going to grow 54% this year, and Palantir's ability to deliver on that target while converting its record bookings into recognized revenue is going to be crucial for their current valuation. So where does that leave us over the coming year? Given Palantir's extreme valuation relative to its peers, I expect more downside in coming months. The stock's forward price-to-earnings multiple of about 150 and price-to-sales multiple of nearly 70 simply doesn't account for Pentagon downside risk and the excessive stock-based compensation that's going to continue to dampen earnings per share. So while Palantir's technology is impressive and growth is strong, investors buying at the current valuation face profound downside risk. And unless Palantir can dramatically accelerate the revenue growth beyond current projections or reduce their reliance on stock-based compensation, expect continued pressure on the stock over the next 12 months. Are you ready to discover some great investment opportunities? Visit fool.com/invest to receive the top 10 stocks to buy right now. That's it for today. If you found this insight valuable, hit that like button, subscribe for more, and help make our community smarter by sharing your thoughts on Palantir in the comment section below. Stay foolish, and we'll see you here next time.